Oh, there's so many yummy vegetarian options out there. You could try like lentil soup, veggie burgers, tofu stir fry. The possibilities are endless. Hey, welcome to The Explainer. So if you're self-employed in Canada, you know tax season isn't just a deadline. It's a whole different animal, right? Today, we are going to break down that super complex world of self-employed taxes into a simple playbook, one that's designed to help you no matter what you do for a living. So here's how we're going to tackle this. We're going to follow a kind of taxpayer's journey. We'll start with why your profession actually matters to the Canada Revenue Agency, the CRA. Then we'll get into the essential toolkit that every single business owner needs. From there, we'll dive deep into some really specific industry profiles. We're talking everyone from artists to farmers. And finally, we'll wrap it all up with the key questions you absolutely need to ask your advisor to really take control of your financial future.
All right, let's just dive right in. Look, the first thing you have to get your head around is this. The CRA doesn't just see a generic small business when they look at your return. No, they see a specific type of business, and that perception completely shapes how they look at everything you file.
And that leads to a pretty crucial question, right? Is your business a potential audit target? Well, the answer might actually surprise you. Your industry, the very nature of your work, can put you squarely on the CRA's radar. And that's because they use this really powerful tool to spot anything that looks even a little bit out of the ordinary.
So, that tool is called industry profiling. You know when you file your taxes and you have to put in that industry code? Well, that's not just for stats. The CRA uses that code to compare your business to everyone else in your field. They're looking for patterns, for averages, and if your numbers, your income, your expenses don't quite fit the typical profile, yeah, that could trigger a much closer look. In fact, the CRA has actually identified certain industries that they consider high risk. They're looking for folks who might be part of what they call the underground economy. So think about, subcontractors in construction or maybe direct sellers. Now, if your business is on this list, it absolutely does not mean you're doing anything wrong, but it does mean your probability of an audit is higher. The key, as always, is just to be prepared and keep amazing records. Okay, so before we get into all those specific industry profiles, let's build a really solid foundation. Think of this next part as the core rules and responsibilities that apply to pretty much every single self-employed person in Canada, no matter what you do. This is basically your universal checklist. I mean, for example, you have to report your income on an accrual basis. What does that mean? It means you report it in the year you earn it, not necessarily when the cash hits your bank account. Or think about entertainment expenses. Just having the receipt isn't enough. You have to write down who you were with and what the business purpose was. These are those fundamental habits you have to build as a business owner. And this brings us to a really crucial point. You know that famous June 15th filing deadline for the self-employed? Well, here's the catch. It gives you more time to file, but it does not give you more time to pay. Any taxes you owe, they are still due by April 30th, period. And interest starts ticking the very next day. And here's another big one. That $30,000 revenue threshold, the second your gross revenues in a year cross that line, bam, you have to register for, collect, and send in GST or HST. All right, so now that we have the basics down, let's get to the interesting part. Let's see how these universal rules get bent and shaped to fit the unique challenges and opportunities of different professions. We're going to look at a few really practical examples. First up, let's talk about our creative professionals. For an artist or a writer, that path from passion project to actual profit can be super long and really unpredictable. And for years, this caused a ton of issues at tax time. But fortunately, the CRA's perspective on this has actually evolved a lot. And this is maybe the single most critical distinction for any artist. See, in the past, the CRA used what was called a reasonable expectation of profit test. So if you had losses for a few years in a row, they might just say, nope, that's a hobby, and all those losses would become non-deductible. But now the test has shifted. The big question is, does a commercial activity exist? It's a subtle change, but it's huge. It gives artists so much more confidence to deduct legitimate losses against their other income while they're still building their career. So how do you actually prove it's a business and not just a hobby? Well, the CRA looks at a whole bunch of factors. Like, are you spending a significant amount of time on your art? Do you have a history of exhibitions or publications? Are you actively out there trying to get gallery representation? Do you have a business plan, even if it's just an informal one? All of it, your qualifications, your training, your efforts to promote your work, it all comes together to build the case that, yes, you are running a business. And believe me, the payoff for establishing your work as a business is huge, because then you can start claiming some really unique expenses. We're talking about things like an agent's commission, the cost of lessons you take to develop your talent, insurance on your instruments. You can even claim depreciation, what they call capital cost allowance, on things like musical scores or a specific wardrobe you use for performance.
Okay, next up, let's switch gears and look at childcare providers who operate out of their own homes. This is just a classic example of what's called mixed use, where your personal life and your business life are all happening in the exact same space, and the tax rules have to figure out how to deal with that overlap. Now, their biggest and honestly most complex deduction is for the cost of their home workspace. The dilemma is always the same, right? But I use my whole home for the business when the kids are here. The CRA gets this, and they actually provide a specific formula to solve it. You take your total home operating expenses, and you multiply that by two fractions. The first is the percentage of square footage used for the daycare, and the second is the percentage of time the daycare is actually open. It's a really precise way to allocate those shared costs fairly. And the list of other deductible expenses is also super specific to this profession. I mean, it goes way beyond typical office supplies. You can deduct things like food for the children, art supplies, diapers, toys, even the entrance fees you pay for trips to the park or other little outings. As you can imagine, keeping meticulous records here is, well, it's absolutely essential. And finally, let's turn to farmers. Now, this group, they have some of the most specialized and, frankly, advantageous tax provisions available in the entire Income Tax Act. And they're all designed to address the incredible volatility of their industry. So one of the biggest advantages for farmers is the option to use the cash method of accounting. Remember how we said a minute ago that most businesses have to use the accrual method? Well, farmers don't. With the cash method, income is only counted when the money is literally in your hand, and expenses are only counted when you actually pay them. This gives them incredible flexibility to manage their income flows from one year to the next. And the special rules really don't stop there. Farmers have these unique inventory adjustments that help them average out their income over several years, which is great for smoothing out the big highs and lows. There are special deferral programs for if they're forced to sell off livestock because of a drought or a flood. There are even specific rules for part-time farmers and special depreciation classes just for their equipment. It's a whole different world. But what if you're not going it alone? What if you're running your business as a partnership, especially with your spouse? Well, that adds a whole other layer of complexity. And the rules here are all designed to make sure everything is, legitimate. You see, the CRA looks very closely at spousal partnerships. They want to make sure they're not just a sneaky way to shift income to the lower earning spouse just to reduce the family's overall tax bill. So to avoid what's called the attribution rules, it has to be a real bona fide partnership. What does that mean? It means both spouses have to be actively involved, or at least have invested their own capital into the business. The CRA can even step in and adjust how you split the income if they feel it's not reasonable. This is why having a formal, written partnership agreement is, well, it's absolutely essential. Okay, so now you're armed with all this information about industry profiles, special rules, and different business structures. The final and most important step is to translate all that knowledge into a concrete action plan with your tax professional. And you should start with the big picture structure. Ask them, what's the best structure for my business right now? Am I better off as a sole proprietor, where I can use those startup losses to offset my other personal income? Is a formal partnership the right move? Or is it maybe time to incorporate for better tax efficiency? This decision can change as your business grows, so it's a conversation you should probably have pretty regularly. Next, don't be afraid to talk about losses, especially in the early years. But you have to be proactive. Ask your advisor about the specific loss filing rules that apply to your industry profile. Because as we just saw with artists and farmers, the rules can be wildly different, and knowing them is the key to staying compliant while you build your business. And to help with that conversation, a tool like this 5-year overview worksheet can be just invaluable. It helps you chart your income, your expenses, and your profits all out over time. When you look at your business this way, the crucial point becomes crystal clear. It moves the whole conversation beyond just what happened last year to the much bigger question, are you building a sustainable, profitable business? And answering that question, that is the real key to mastering your taxes and securing your financial future.